One of the questions that Scott and I have been getting more and more lately is how do I go about dropping my mortgage insurance? Now, what we're going to be talking about specifically here is going to deal with conventional loans. If you have a USDA loan, FHA loan, it's going to be a different set of rules, but this is specifically for conventional loans. So we're going to go through the top 3 ways that we're seeing clients drop mortgage insurance.
All right, the first way is if you have an 80% loan to value or LTV, and all that really means is that you have 20% equity in the home. The lender calculates that 20% equity based on either the purchase price or the appraised value, whichever is lower at the time you obtained this loan. And all you do is you just pick up the phone, call the lender, we call it the servicer, but really it's whoever's collecting your payments, and tell them I'm at 80% LTV. I've got 20% equity in my home now based on, paying the principal down. And they're going to just say, fine, as long as you've had this loan for at least 24 months and you haven't had a late payment in the last 12 months, we'll go ahead and take that mortgage insurance off. So that's a fantastic way, and people do it all the time. The other way is to get to 78% loan to value, which is a fancy way, again, of saying you've got 22% equity in the home. In this case, you don't have to do anything because there are laws in place that force the lender to remove your mortgage insurance as soon as your loan is paid down to the point where you have 22% equity based on, like we said before, either the purchase price or the appraised value, whichever was lower at the time you got that loan. So, it's nice because there's this safety net in place. But I am going to say that if you can pay attention and know at what point you're going to be at 80%, make the phone call, because you're probably going to save over $1,000 if you do that. I'd probably even just put that number, like what principal balance do I have to get to, write it on a little yellow sticky, put it on your fridge or something so you're super aware of it. And that way it won't get away from you, because that's the best way to save money. The other option is to look at the equity in your home based on a current appraisal. Now, Zach, you recently did this, so would you speak to that?
Yeah, so this what the lender's looking for is they want to make sure that there's enough equity to remove the mortgage insurance. Now, typically they'll end up wanting to see anywhere from 25 to 30% equity in the home. And the way that they're going to go about doing that is one of 2 ways. They can either send a real estate agent out there to do what they call a CMA, the certified market analysis, or they can send an appraiser out there to do a full-blown appraisal. The cost varies from about $200 to $500. But I recently did this on a property of mine that I bought back in August of 2020, and I was able to get rid of this mortgage insurance, which in the end saves me right around $80 per month, which it's not a lot, but it ends up being about $960 per year. And so considering it only cost me $200 to do it, it's a really good rate of return.
Yeah, I'm going to say also that if you're thinking about going this route and you're wondering what your house is worth, reach out to one of us, because we actually have some software that we can run your home through, and it'll give us a good idea of where the value is, and it'll give you a feel for, do I even pursue this right now? Am I close enough, or do I wait a little bit longer? But we're happy to help with that. At the end of the day, we just want to help you get out of paying a mortgage insurance. We want to save you as much money as we can and do it as fast as we can.